Hello and good afternoon, everyone. Thank you all so much for taking the time to join us today. My name is Mark Bolger. I'm the Director of Sales for the Life, Annuity, and Long-Term Care here at Pinnacle Financial Services. My colleague Greg Yotis also works as a Director of Sales, so he's just another contact that we have here at Pinnacle. So we'll get started in just one second. Just want to make sure that everybody can see my screen. Looks like we're good. And we are recording this webinar, so it will be available on our website within the next couple of days. So if you need to go back, you will get a follow-up email, with a link for you to go back on. And then you can also check out our website as well, pfsinsurance.com, and you can go under the solutions tab and over to the training. So one quick thing too, anybody that's a brand new agent or not affiliated with Pinnacle yet, a simple way of coming on board, is just going to our website, pfsinsurance.com, look something like this, and you can click on the Contract Now tab. And this is our spot sign onboarding contract system. Very simple, just need like your name, NPN, date of birth, and then you have all of these carriers that are available here. So this is across the board with Medicare, ACA, life insurance, annuities, and long-term care, as well as some ancillary products. So if you're not sure, most of these carriers, either specialize in one of those product lines, or they might include several ones, such as Medicare and life insurance. But you can always give us a call, shoot us an email, let us know, if there's a specific company that you're looking for, and we'll be able to, let you know what products that they offer. The form also asks you, you can select as many states that you're licensed in, obviously your address. If you're a downline of a specific agency that's already affiliated with Pinnacle, you can notate that in here under upline agency affiliation. If you are direct to Pinnacle, you can just type in Pinnacle. That way we'll know to get you set up direct. And it's going to ask for your EFT, and if you are an agency or a corp, your W-9. And the reason why it asks for the EFT is because all of these contracts are direct. So we do not pay any commissions out. We utilize that EFT form to send to whichever carriers that you're contracting with, because they're going to pay the commissions directly to your bank account. So that's why we ask for that. And then just as simple as that, you'll click submit, and then we'll get those contracts processed within 24 to 48 hours. You'll receive some follow-up links, usually from Surance Bay, which is the online contracting portal. And that way you can complete the appointments. Once you send that out, carriers usually have a 5 to 7 business day turnaround from there. Okay. So again, plenty of things that we offer too on the Pinnacle website. As you can see, we have all the quoting software for life, annuities, Medicare, long-term care. We also have the e-app platforms for most of the life insurance products, and that's going to include the term universal life and some of the whole life plans. But final expense is the only product line that we do not have the e-app platforms for on our website, because they're a little bit more strict. They require you to submit the e-apps through the specific carrier websites. So just wanted to kind of note that. We'll get started here. Today we're going to be doing, Life Insurance 101, just pretty much an overview on what type of life insurance is available, what types of life insurance you can sell through Pinnacle, how they work. We'll go through some underwriting, and then we actually have some resources for you. Besides the quoting software, if you're new to selling life insurance, you're not sure, what product do I quote for this client, all that kind of stuff. So we have like a brief 2-page fact finder that you can utilize and just fill in the information that on your client, and you can send it over to us here at Pinnacle. We'll do the research for you. We'll come back and say, hey, based on your client's health and their budget or whatever their needs are, this is the product that we would recommend. And we'll usually give you a couple different options, or maybe like the top 2 or 3 carriers, just to give you an idea of what that pricing looks like. So that way you don't have to spend all this time, doing the research and, you know, um, making sure that you're finding the right plan for your clients. So just keep that in mind. And without further ado, we will get started. I did put a handout too for everybody to download, and that is that life insurance fact finder form. Real quick, it just kind of looks like this. So again, it's just a 2-page form, collect some basic information on your clients, their health and lifestyle, their financial snapshot, goals and objectives, and just, an idea of, a little bit of a cheat sheet on, what type of plans usually will fit best for your clients. We have our email address, the lifesales at pfsinsurance.com, that you can send this to. And again, we'll go back, do all the research, and find the best type of plan that's that's going to benefit your clients the most. We always say, like, try and collect as much information as you can. The more, the better. But if you don't necessarily have the balance of their mortgage or their total debt, things like that, we can work with just their date of birth and the state that they live in, and just a quick overview on their health, and then maybe what their budget is, and we can work with that. So very good. So here we go. We'll get started. I'm going to start the PowerPoint presentation. And just give me one sec. Okay. So Life Insurance 101, like I mentioned, we're going to be going through, the core purpose of life insurance, the product types, underwriting basics, and some discovery techniques that every agent on the call will be able to utilize going forward. And again, here's all of my contact information as well as Greg's. Feel free to give us a call, shoot us an email. Any questions that you have, we will be more than happy to assist you. Okay, let's go on to the next page here. All right. So the core purpose of life insurance. At its simplest, life insurance is a contract between an individual and an insurance company. So in the exchange for premiums, the insurance company is going to provide a lump sum payment, which is called the death benefit. And they're going to pay that out to the client's beneficiaries. So they can have one beneficiary, multiple beneficiaries. They can split it up however they want. Or, if it's in the case of like a business, sometimes, business insurance, they can have the business as the owner and payer as well as the beneficiary. So those are some things that we can talk about. But one of the biggest things too is that death benefit that's paid out to the client's beneficiaries, that is a tax-free death benefit. So just keep that in mind. If it's $1 million policy, the client were to pass away, that beneficiary is receiving $1 million tax-free. Okay? So some of the reasons why people should be looking for life insurance, income replacement. So in the event that the breadwinner were to pass away, you want to make sure that those dependents or beneficiaries can maintain their lifestyle. So you might have a husband and wife, they might have 3 kids, maybe they're young kids or however old, doesn't really matter, but that death benefit, in the event that the husband or wife were to pass away, maybe they're the main income earner, right? So we want to make sure that the family can pay off the mortgage or pay off any any debts that would affect them from having to let's say leave their house and move somewhere else, something that would be detrimental to to the family if something were to happen. You also have debt protection. So I did mention the mortgage. You also have car loans, personal credit. All of that stuff certainly adds up. So again, in the event that someone passes away, you don't want that debt to be passed along to another family member, because those creditors will come after anybody that's like related to that person that passes away. So just another reason why people should get life insurance. You also have your final expenses. So designed for some older individuals, usually between ages of 50 and 90. These are very simplified issue products, and they usually have very small death benefits. But somebody that doesn't want to have to leave the burden of their funeral and medical costs to a family member. So just think about it, like if somebody were to pass away today, you usually need that money pretty quickly. Most of the times those funerals are going to be within a couple days, and they can certainly run about ten to $15,000. And you want to ask your clients, is that something that your family's going to have ready to go right away? Most likely not, and you don't want to have to do something like a crowdsource or, a GoFundMe to have to raise money to help pay for some of that stuff. So those are very simple, very small little chunks of, death benefit protection that people can get for very, inexpensive as well. You also have wealth transfer. So you want to pass, again, that inheritance tax-free to the next generation. And we have a lot of clients that, that do that, and they set it up through, some of the universal life plans, ones that, build, cash value throughout the life of the policy, but also have that large death benefit that they can pass on to transfer the wealth to their next generation. So one of the first products we'll start with, and this is just one of many that we'll get into, but you have your term life. So this is just pure death benefit protection. It's designed for temporary needs. And usually, the coverage amounts are going to be for a specific term period. You usually have 10, 15, 20, or usually the max, which is about 30 years. And this is usually the most affordable type of life insurance. It has the highest death benefit for the lowest premium. And essentially, you're renting insurance. It's not something that you own because it's going to expire 10, 20, or 30 years down the road. So therefore, the insurance companies can offer it at a very low and affordable premium, for large death benefits. So, and just keep in mind too, those premiums are always going to be level. That means that they're fixed, and it's going to, remain fixed for the duration of that term period. So if the client's quoted a term plan for, $50 a month, that's how much they're going to be paying for the rest of that term period. Okay. Term does not include any cash value. Like I mentioned, it's just pure insurance. So when that term ends, the coverage ends. Okay. These are best for, your young families or people that are looking for mortgage protection. Maybe they're starting a business. This is typically what we'll see. But just keep in mind that this is for healthy individuals. They do usually have a pretty rigorous underwriting process. So, if they have certain health issues or, any financial issues or things like that, then, it could be an issue with them qualifying. So we'll be going through that a little bit later during the presentation. But like I mentioned, we have the 30, the 20, 15, and 10-year terms. 10 is the minimum. We don't have any like 5 years or anything like that. But just keep in mind, too, the 30-year term is only going to be available for ages 18 to 55. It's usually going to be, up till age 85 is usually like the cutoff period. So, if somebody is 75 years old, the max they can get is 10 years, right? Because 85 would be that max. So somebody who's 55, they could get 30-year term because it would go till age 85. 20-year term is going to be available ages 18 to 65. Your 15-year term, ages 18 to 70. And then your 10-year term is going to be ages 18 to 75. And this is just a quick example of how term life insurance works. So let's say we have a 45-year-old male, $500,000 death benefit. The premium is about $100 per month, so very affordable. It's nothing that's too crazy. This would be great for mortgage protection. So in the event that this client were to pass away, maybe they have $300,000 or $400,000 left on their mortgage. That $500,000 death benefit would certainly be able to cover that, so that the family would be able to stay in their home. So you can see this is a 20-year term, so it's only going to cover that client till age 65. Now, another thing I didn't mention too is almost all of these term policies that we offer here are convertible. That means that they can convert that term policy to a permanent policy at any point during the life, at any point during the term, as long as they are before the age of 70. 70 is usually the cutoff. So if it's a 10-year term and they're 65 and it's going until age 75 and they want to convert and they're 73 years old, it's not going to work. But the conversion allows them to, again, convert it to a permanent policy without any evidence of underwriting. So they don't have to go through any underwriting at all. Let's say in this example, this client's 45, he has a 20-year term. Let's say year 19 in the term that he has 1 year left, and he's 64 years old, and he wants to convert this to a permanent policy. He can convert up to $500,000 to a permanent plan. Now, if he does that, that $500,000, that's going to be very costly. It might, cost him $500-600 a month because that death benefit is so large. However, he does not have to go through any underwriting. He could currently have some sort of, cancer diagnosis or something like that, where anywhere else he would be uninsurable. But most of the time, what we see is people want to, keep the policy. They want to convert the policy for the rest of their life, something that's going to, be around, but they usually want to keep the premium about the same. So in that event, if this client wanted to convert this at age 64, he wants to pay $100 a month for the premium. Generally, that death benefit is going to be reduced by about 10% of the death benefit. So $50,000 of permanent coverage would most likely cost, that $100, per month. And usually that's the time where people hey, the mortgage is paid off, the kids are out of the house, most expenses have, kind of been taken care of. So that $50,000 is great for, covering final expenses and covering any, small debts, that are outstanding and whatnot. So generally people are okay with it, but just know that they can convert up to the same amount that they have, but it's usually a little bit more expensive when they do that. So like I mentioned, it's like renting a home. So coverage is for a set period. This little graph down here kind of shows that, over time, the premium stays pretty level. And then, after 20 years, most plans, they do allow you to keep going if you wanted to, but I'll tell you, it would go from like $100 a month to like $3,000 per month, each year going past. So that conversion option is certainly very attractive to clients that are looking for this type of policy, knowing that they can convert it to some sort of permanent plan. Usually it's a whole life or an indexed universal life that the clients, have that option to go with. They do have to keep it with that same carrier. They can't go shopping it to different carriers or whatnot. But yeah, pretty much every term company is going to have that, that conversion eligibility up to age 70. So switching gears, going over to the permanent life insurance, this is lifelong coverage or lifelong security. These are designed to last a lifetime, usually till age 100 or beyond. So most of the maximums you'll see is to age, guaranteed to age 121. And the permanent life, most of these are going to include that savings component, which is the cash value. Cash value can be accessed through loans or withdrawals for emergencies or to help supplement their retirement income. Most of the time what people do is with the cash value accumulation, they're going to take out a policy loan because that way it's going to be tax-free. Okay, that's also another very important feature of these. So basically the cash value accumulates year after year. So just to keep the numbers simple, let's say every dollar that the client puts in for the premium, about 50% of that, each dollar is going to go into a cash value fund essentially. And that's just a very high interest earning, fund that, year after year, it's going to increase substantially through, compound interest. So you might say after the first year, the client's paid, let's say $1,200, after the first year into premiums, that cash value might be, let's say, $500 or $600. But year after year, that keeps going up. So they're not designed for short term. It's usually for, a good 15 to 20 years, and then you'll start seeing substantial cash value accumulation. And sometimes that cash value starts to equal the death benefit. And at that time, you'll see that the death benefit starts increasing as well. So these are very beneficial and very popular. We get so much different types of permanent life, business, whether it's whole life or the indexed universal life, which is usually the best way to maximize cash value accumulation. So of the 3 permanent life products or solutions that we offer, we have the whole life, which whole life is fixed premiums, guaranteed death benefit, and guaranteed cash value growth. So what that means, the guaranteed cash value growth is year after year, that cash value is going to grow at a fixed interest rate. It's always going to be roughly around 4%, maybe a little bit more if it's a participating whole life company, meaning that they pay dividends on top of that 4% growth. So sometimes that can look like, 5, maybe 6%. And, you can look 20, 30 years down the road and say, I know exactly how much cash value I'm going to have in that policy to the penny. Okay, so it's guaranteed. Same thing with the death benefit. It's guaranteed, regardless of when they pass away. Most of these whole life, you'll see they have a guaranteed death benefit till age 121. And again, those premiums, they're fixed. They're never going to, increase or decrease. And you'll see that that whole life applies to both to traditional whole life, which is like death benefits over 50,000, and then also final expense. Final expense are small whole life policies that typically range from as little as 5,000 up to a max of 50,000. And we'll talk a little bit more. Final expense is designed for seniors, especially if they have health issues. It's a very simple and even like a guaranteed approach for clients. So if they have health issues, there's no problem with them getting some sort of coverage. Simplified underwriting, so there's no medical exam. It's just a couple yes/no health questions, and then they are, approved right from the start there. So just to keep in mind too, whole life is always going to be, the most expensive as well. Whole life is like the oldest form of permanent insurance, and again, because of the, it doesn't offer the flexibility that we'll talk about with the universal life, which is a little bit more of like a modern solution. I'll say maybe within the last 50 years or so when those started coming around. So that's your whole life. And then you have your universal life, which are flexible premiums, adjustable death benefit. You can, the clients can get that, and, they can pay, what's called like the maximum premium or the minimum premium, or most of the time we want to start them off somewhere in between, which would be called the target premium. But, it's definitely flexible because, maybe the client's paying $300 a month, and then for some reason, they can't afford that in a specific month. So instead of whole life saying, oh, you have to pay us $300 a month or this is going to start lapsing, or has the, jeopardy of lapsing, universal life is going to say, hey, pay the minimum premium, which might be $150, right, for that, that policy that they were paying $300 a month on, and that will keep the policy from lapsing. Okay, so and then conversely, they can pay a maximum premium, which might be in that example $500 a month, and that way it will actually maximize cash value growth, and it's just an option for the clients. The adjustable death benefit means that you can have a level death benefit where, let's say, it's always going to start at $100,000, and it'll be that way up until that cash value starts to equal the death benefit. Then it will start increasing. Or from day one, you can start with an increasing death benefit. So it might start off year one as $100,000, but then year two it might be $102,000, and then each year, going down the road, that death benefit will increase, for the life of the policy. And the best way to see what that looks like, we have what's called illustrations. Each carrier offers those, or you can always reach out to us if you want to see like some sample illustrations for your clients. So you can see what that cash value accumulation is going to look like 10, 15, 20 years down the road, or, what that increasing death benefit looks like, 20, 30 years down the road and whatnot. Okay. And then finally, we have the indexed universal life. So these are designed for cash value accumulation. They are tied to a market index, such as the S&P 500. Most carriers have, a handful of different market indexes that you can, allocate the cash value to start growing from. And what they have is a floor to prevent losses. So what that means is, the cash value is not going to always be that 4% year after year like the whole life. It might go anywhere from, a minimum of, let's say, 1% up to maybe a max of 12 or 13%. So it's very, very attractive for clients to go with an IUL, or Index Universal Life, as opposed to the whole life because they have such more potential of accumulating much more cash value over the life of the policy. However, it's gonna fluctuate. So let's say the market has a 20% overall positive year, the clients are going to get a maximum of, let's say, 12 or 13%, which is called the cap. And conversely, if the market has a negative 20% overall year, then they're not going to lose any of their money. They're just going to get that minimum, which is usually about 1%. Some carriers have a 0% floor, meaning that they're going to get very minimal interest, rate that specific year. Okay, and the ways that the carriers can kind of determine this is they look at historical performance of the various index accounts. So the S&P 500, for example, it's usually positive 8 out of 10 years. That's usually the safest bet. But other times they have some other ones that you can certainly see, and you'll be able to see what the historical performance looks like. And the way that they'll again, when you illustrate it, they're not going to illustrate the cash value at 12%. They're not going to illustrate it at 1%. They're going to usually illustrate it somewhere in the middle at about 6, maybe 7%, just to give you the clients a rough idea of what the cash value is going to look like 10, 20, 30 years down the road. Again, it could be a little bit more, it could be a little bit less. It's not as exact as the whole life is. So these are just like the 3 types of permanent types of policies that we offer. Some might say, well, what's the difference between an indexed universal life and just a regular universal life? So the universal life is usually going to have kind of similar to the whole life, where it's going to have a very low interest rate. It might be between 3 and 4%, but therefore, because of that, the cash value is not going to accumulate as much, but it's going to cost a lot less than doing an indexed universal life. Okay, so when cost certainly matters, a lot of times people are just concerned more about preserving the death benefit and keeping the costs as low as possible. And sometimes they don't mind. Hey, that's great. You'll have a little bit of cash value accumulation, but it's not necessarily designed for those people that are looking to maximize that. So I always say the universal life, or the GUL, which is like guaranteed universal life, meaning that guaranteed death benefit for the rest of the client's life, usually till age 100 or beyond. It's going to focus more on that death benefit protection, and is going to be the lowest cost out of any of these permanent life plans. So like I mentioned, whole life is going to be the most expensive most of the time, and then sometimes the IULs are going to be right, within a little bit, sometimes a little bit under where the whole life, prices are going to be. And then the UL, regular universal life, is going to be the most affordable, the cheapest form of permanent life coverage. And this is just a graph here, just kind of showing, again, a 45-year-old male, $500,000 death benefit, and we can kind of see what the costs are. So with the indexed UL or IUL, it's about $350 per month. The whole life, again, a little bit more expensive, about $400 per month. And then the GUL, which is just your regular universal life, you can see that that's well under the cost of the others. It's about $250 per month. So again, with the IUL, you have your flexible premiums, you have the cash value that's linked to the market index, and again, has the potential for higher growth. And any of the growth that you have with the cash value is going to be tax deferred growth as well. So you can see in the little chart here that that cash value goes up and down a little bit each year. However, they're never going to lose any money. They will always gain money, and that's the protection that the insurance carriers offer. A lot of times people ask, well, what about a variable life insurance? And that's a great question, because variable life insurance is tied directly to the markets. It has no protection from the insurance companies. So, it might have the potential to earn a lot more cash value, but it also has the ability to lose cash value. So if the market has a negative year, they're going to lose money out of that policy. So it's not safe. It's not protected like these plans are. And we don't even offer any variable life insurance. It requires you to have a security license, and it's just something that we don't offer here. Usually would have to go through like a broker dealer and hold those Series 6 and 7 licenses. And also too, just letting you know, all you need is a life insurance license to sell these types of policies. You do not need some sort of, specific securities license or FINRA or anything like that. Just a regular life insurance license will allow you to sell any of these plans. In the middle, you see the whole life. Again, the most expensive, fixed premiums, guaranteed cash value, about 4% annually, tax deferred growth, just like the IUL. And, they say this is kind of like buying a home, exactly, the value of it. And that cash value is just going to, keep increasing steadily at a fixed interest rate year after year. And then finally, the universal life usually has fixed premiums. Some of them will allow a little bit of flexible premiums, guaranteed death benefit, but little to no cash value accumulation. So that's why that is the least expensive option here. So to compare the two, we have the term versus permanent side by side. You can see that the duration of term life is only going to be for 10 to 30 years, lower initial premium, no cash value, and really no flexibility, right? It's static. You have to pay those premiums, or if you don't, then the policy is going to lapse and not pay out any sort of death benefit. And then you have the permanent on the right-hand side, where it's it's lifetime duration. So as long as they're paying that premium, they are guaranteed a death benefit. Again, higher initial premium, cash value builds over time, and then flexibility. You have very high flexibility with the universal life, not the whole life. But again, that's the flexibility is more for the premiums. And then just some of the underwriting basics. We'll go into this in a lot more detail over the next couple slides, but underwriting is going to determine the risk and sets the price. So just because a client's a certain age doesn't mean that they're going to get the best rate. They might get something a little bit higher depending on their health history that we'll go through. Some of the key factors are going to include their health, obviously, so their age, their weight, medical history, tobacco use, things like that. But also their lifestyle, so their driving record, any hazardous hobbies, like maybe they're they have a they fly planes as a hobby, or maybe they are an airline pilot, scuba diving, things like that that are hazardous. Could certainly affect the underwriting. And then the financial alignment. So we want to make sure that does the death benefit match the financial loss. So if somebody's earning let's say $30,000 to $40,000 per year, they may not qualify for like $1 million death benefit. Usually a good place to start is multiply their annual income by 10, and that's a great place to start for coverage, because anything over that is usually going to get declined by the carrier, and they might come back and say, hey, we can only offer a maximum due to their income and assets and things like that. Okay. So again, the rate classes are going to range from preferred best or super preferred, and then you have substandard table ratings. So usually, there's table A through H usually, and each letter or number that substandard table rating is at, then that means that the higher premium is. So as an agent, the field underwriting, you want to make sure that you're asking the right health questions early. It's going to save time and set the client's expectations. I can't tell you how many times I'll get something that comes in and, they quote somebody super preferred, and they're, 68-year-old male or female. And I'll say, well, where'd you come up with super preferred? How? A lot of times the clients didn't just say, oh, they said they're in good health. Well, that's not doing your job there, right? You're not going through some of the key factors and the key questions that we're asking. Right. And we'll talk about those in the next couple minutes. But yeah, just on that same point, it's very rare for anybody 55 and over to get a super preferred rating. I don't think I've ever seen it. At best they might get a preferred, but a great place to start when you're running quotes is run them at standard, because you don't want to submit a policy where you submit them at preferred and it costs them $100 a month, and then they come back getting the standard rate, and now it's going to cost, $200 per month. Well, what happens? The clients are upset. Why'd you quote me? It was, this made sense at the time. Now I don't want this policy, or now we got to go back and we got to adjust it. So, it's just, it it's always going to create a mess most of the time. So always keep that in mind. I just, as a general rule of thumb, I'm almost always going to quote somebody at standard, regardless of their age, unless the agent gives me like a full breakdown of, their health, their lifestyle, their finances, things like that. Then that will help me determine that. And that fact finder that is attached to this, that's going to help you collect that information from your client. It's going to take you 5 minutes to ask those questions. It's not, it's not a headache or anything like that. But you'd be surprised. Not many agents go past just getting the date of birth and, the gender of the client. So do a little bit more homework, and it's going to ensure that the client's expectations are going to be met there. And again, it's going to save time as well. So discovery and next steps. So great agents don't sell life insurance, they solve problems. So use these discovery questions to uncover your client's needs. So number one, we have, if you didn't come home tomorrow, how long could your family stay in this house before they had to sell it? It's a great question to ask, right? This gets them thinking, on the emotional level. Wow, you know what? I really need to get some sort of protection because right now we don't have anything. And that could certainly, be detrimental to a family, God forbid, if somebody were to pass away. Number two, do you have coverage through work? A lot of times people will say, well, I already have coverage through work, I'm good. Well, most times if they leave that job, those plans are not necessarily convertible or portable, I should say. So if they have coverage through work, that's great, but it certainly makes sense for them to get, their own sort of independent, individual coverage, because you never know what type of policy they have through work. Most times when you ask a client, they're not going to really know. They might know how much it is, but they don't know all the ins and outs. And, that would require them to talk to their HR person at their job and kind of get those details, because it could be a 50-50 shot whether, the plans are portable, if they leave the job or if they quit, get fired, whatever. You want to ensure that protection, is met for those clients. Number three, are you interested in a vehicle that can provide tax advantage growth for retirement? So that kind of gets into the whole life or the IUL. Okay. Number four, what is the most important financial goal you want to guarantee happens, whether you are here or not? Okay. That will help determine what type of coverage might work the best. And always just keep in mind too, we have a lot of clients that will purchase a term policy as well as a whole life or an IUL plan, right? It's going to maximize their death benefit coverage for 20 or 30 years. And then by the time that term plan expires, hey, guess what? They had 20 to 30 years for that cash value to really accumulate. Maybe it's now a couple $100,000 in cash value by the time that term expires. So that might be plenty, of coverage for that client, and it's almost always very attractive. So don't think that they have to just get one plan. They can certainly get multiple plans, as long as it's affordable and it makes sense, or we can always design those cases to fit within those parameters. So we're going to get into a little bit of the underwriting checklist. So this is a little bit of a comprehensive guide to help you pre-qualify clients and prepare them for the application process. So this is going to include some key questions that the carriers ask, whether it's through a phone interview, or most of the time carriers send like an email interview. They call it the online interview. Sometimes it's a little bit easier for clients to do. And then the medical Part B phase. So a lot of times if you submit an e-application, it's just going to collect some of the basics on the client, such as their height and weight, their address, their date of birth, the beneficiaries. And then once it gets sent over to the carrier, the insurance company is going to contact them to do that Part B type of phase, which is a little bit more digging into the underwriting. Okay. So some things to keep in mind too, and this is always great to know this stuff, because there's nothing worse than talking to a client for a couple hours or a couple days and then to find out like, oh, they don't have, one of these conditions that are needed to obtain the coverage. So some core demographic and financial things that you want to make sure that the clients have. Obviously, a social security number and ID that's required for the MIB and motor vehicle report checks. So, unfortunately, if they're not a citizen, it's very, very difficult to get some sort of coverage. The carriers are very, very strict with that. So you want to ensure that they have a social security number as well as like a driver's license. Okay. Their income and net worth. So that's going to be, like I said earlier, that's going to be used to justify that death benefit. So for an example, a 30-year-old who's earning $50,000 per year, they typically cannot qualify for $5 million dollars in coverage. They could typically get about 10 times 50,000. So that would be what? $500,000. Great place to start. Any existing coverage. So the carrier is going to ask, is this new policy that we're applying for, is that going to replace an existing one? Or are they going to keep that existing one and add this new one as coverage? And that also gets into the point, too, that maybe when you're talking to a client and you're trying to sell them life insurance, they might say, well, I already got coverage a few years ago. Well, you never know what type of coverage they have. So it doesn't hurt to ask them, okay, well, how much are you paying? Is it a whole life, or, does it accumulate cash value? And you'd be very surprised. As long as they purchased it within the last few years, it's very possible that we can beat those prices and get them into a new plan. And how they would do that is they would replace that existing coverage with a new one, so that there's no lapse in coverage. And, we get calls all the time where clients, purchased a policy, recently, and we can almost always, find something that's a little bit cheaper. The reason for that is we have dozens of insurance carriers that we work with. We work with all the A-plus rated companies. You can certainly check out an entire list of our life carriers on the Pinnacle website, and we'll kind of go over it a little bit towards the end. So one other thing, too, is the citizenship. So I did mention, the Social Security, but they do most of the time just need to be a U.S. citizen. If they aren't, it's going to be very tough to get them something, especially if it's final expense. If they don't have a green, if they're not a U.S. citizen and they just have a green card or a visa, then that's going to knock them out of qualifying for any sort of final expense. If they were to try and get like a term or an IUL, there's limitations. Like they have to get maybe like a maximum of $1 million per term, or they have to get, or I should say, a minimum of $1 million per term, and maybe like a minimum of $250,000 for an IUL. So they can't just get like a small one or things like that. So lots of limitations. Those are very, very difficult to work with. Again, not every carrier is going to allow that. But if they are, just reach out to us. We'll get you the parameters and guidelines, because it's not just going to be for anybody that just has a green card or just has a type of visa. Okay. So some of the medical history questions. So and a lot of the questions, it's going to cover a 5 to 10 year window. So maybe if a certain health issue, a client has maybe 15, 20 years ago, it may not be applicable, right? It's usually within the last 5 to 10 years. So number one, prescriptions. Very easy question to ask clients. What medications have you taken or been prescribed in the last 5 years? It's okay if they don't know all of this, or if they're not telling the truth. The carriers are always going to be able to access the pharmacy database to ensure that they're getting all the correct information. So if a client does leave something out, or is not willing to give you this information, it's going to be very tough for you to estimate what type of coverage is going to be acceptable for them. Okay. Chronic conditions, again, within the last 5, 10 years, high blood pressure, high cholesterol. High blood pressure and cholesterol is not going to necessarily knock them out or decline them, but it might be the difference between preferred and standard rating. Okay. Diabetes or high blood sugar. What was their last A1C rating? Most diabetics are usually okay with like a final expense plan. It can get a little bit pricey if they start going for like a term or universal life. Usually they're in that standard table 2 range, which can certainly be a little bit more expensive. So you can always just let us know what conditions they have. We'll be able to tell you, hey, this is most likely what the insurance company is going to rate them at. Cancer, tumors, melanomas, anything within the last 5, 10 years. I get this question a lot. If a client had cancer 15 years ago and has been in remission and hasn't had any issues in 15 years, generally okay. But if it's at least within the last 5 years, that's going to be declinable for most plans. Maybe final expense might ask in the last 2 years with cancer. Okay, heart disease, chest pain, stroke, any of this stuff in the last 5 to 10 years, it's going to definitely affect the qualification for term or universal life plans. I know for final expense, it's usually a 1 to 2 year look back for stroke, but heart disease is usually something that's a chronic condition, like we're mentioned here, and they're going to be living with for the rest of their life. So heart disease is usually like a guaranteed issue type of final expense. Is really the only type of coverage that they'll be able to qualify for. Asthma, COPD, sleep apnea. I know asthma and sleep apnea is usually going to be the difference again between preferred and standard. It's not going to disqualify them. However, COPD is something that they cannot get anything outside of a final expense plan. They can get a level immediate final expense plan, usually at like a standard rating or whatnot, but they're not going to qualify for any term or universal life with those. Anxiety, depression, bipolar disorder. Again, I know anxiety and depression usually is going to be the difference between preferred and standard rating with any of the companies. Bipolar disorder starts to get a little fishy with them being able to qualify. They might ask for, when was the diagnosis, again, what medications they're on. Some of them I've seen, qualify for term or universal life, but it's usually at a table rating, and those are usually, a little bit more designed for, a final expense type of policy. Hospitalization. So in the last 10 years, they stayed overnight in a hospital or had surgery. And, some people might say, yeah, you know what? I had surgery 2 years ago. I broke my leg or I broke my arm. Totally fine. But they're going to want to know, why they were hospitalized and what that condition was for. And, did they spend one night in the hospital, 5 nights in the hospital, whatever it may be, definitely make sure that they disclose that. And then finally, family history. So have either of the client's parents or siblings died from heart disease or cancer before the age of 60? This can certainly affect the rating. Again, usually preferred, difference between preferred and standard rating for those, any sort of family history like that. Next, it'll bring us to the lifestyle, tobacco, and risk questions. So lifestyle and tobacco, carriers are going to look for little hidden risks that aren't strictly medical, such as tobacco and nicotine use. For those of you that are familiar with this, anybody that gets a tobacco rate, it is very, very expensive. It almost like double or sometimes triples the cost of them being a non-smoker. And that's going to apply to really any sort of nicotine. So that means, cigarettes, pipes, chewing tobacco, vaping, any sort of nicotine replacement such as patches or gum within the last 12 to 36 months. They're going to ask, okay? But as long as if they quit at least for a minimum of a year, then it's okay to submit them at a non-tobacco rating. So marijuana next. This is something that has certainly been updated within the last couple of years across the board with carriers as the legality has increased a lot with various states. So a lot of times this can be the difference between maybe a preferred rating and a standard rating. Sometimes they will actually give a standard non-tobacco rating depending on the amount of marijuana that they're using. And if it's an edible versus the smoking. So an edible marijuana could certainly qualify for non-tobacco rates, whereas the smoking would be sometimes, the tobacco rating. Okay. And all of these, the carriers, they have these little questionnaires. It's like a little checklist, like how much do you use daily, weekly, roughly how much, things like that. Alcohol use. So how many alcoholic drinks do they consume per week? It's okay if they drink, but if it's excessive, and maybe they have a history of maybe DUI or history of some sort of alcohol treatment facility that they were in, that could certainly affect their rating. Drug use. So again, have they ever used any illegal drugs or been treated for substance abuse? So sometimes we'll see that, especially like with the opioids. Maybe they're on some sort of opioid withdrawal medication that may not be currently using the illegal drugs, but that prescription can certainly affect them qualifying for any sort of coverage. Aviation, I mentioned this earlier. So are they, pilot, or do they fly a private aircraft or intend to? That can certainly affect the rating. Doesn't necessarily decline it like some of these others would, but it's going to be more risk for the insurance carriers, and they're going to make them fill out like a little questionnaire as far as how much they do it and things like that. So risk and reputation questions. So these are going to focus on behaviors that correlate with higher mortality rates. So driving record. In the last 3 to 5 years, have they had any moving violations, accidents, or a DUI or DWI? That can certainly affect, maybe they had multiple speeding tickets. That can be something like, hey, we don't want this guy to, crash and have an issue. It means they'd have to pay it out, right? So they want to know that kind of stuff, and that's why they run a motor vehicle report background while during the underwriting process to help them determine that. Criminal history: ever convicted of a felony or currently on probation? So if they've been convicted with a felony within the last 10 years, they are declinable pretty much across the board. But if it was over 10 years ago, then most likely we can get them some sort of coverage. If they're currently on probation, that's going to also disqualify them for any sort of coverage. They usually need to be off probation for, I would want to say, the last 2 to 5 years, depending on the type of coverage that they're looking for. But just keep that in mind. Foreign travel. So do they have plans to travel outside of the U.S. or Canada within the next year? So it's going to focus on high risk or conflict zones. Sometimes, there's a handful of countries that, if they say that they go back to a couple times a year, maybe they have family there, or some sort of interest in traveling there. There's certain countries, and just kind of use your 2 cents on which ones those would be. Usually, kind of enemies of the United States, but it's just very high risk. We don't know. It's not safe for the client to be there. There's just an increased chance or increased risk of that something happening to that client. They want to know that. But most of them are okay. They have some, a list of countries and territories that are okay. Sometimes clients might go back to visit families or for business or vacation, things like that. Sometimes, it's not really going to affect the rate unless it's something that they're constantly going back to, maybe over 2 or 3 times per year. That can certainly affect the rate. And then I did mention the hazardous hobbies, like we have the, pilot, but if they participate in motorized racing, scuba diving below 100 feet, rock climbing, or skydiving, maybe they're an avid skydiver, or they rock climb, 3 to 4 months out of the year, or whatever it might be. Those can certainly affect the rating. Doesn't necessarily disqualify them, but can just affect the rating. And just some of the field underwriting. So this is a little bit of a, just a quick agent cheat sheet that you can utilize. Feel free to take screenshots. Again, I did attach the, fact finder to this, but their build. So their height and weight. What is that? A red flag if their BMI is over 30. Generally, that's, they're considered obese. But generally, you can tell by their height and weight. And, again, if you provide that information to us, or if you're putting it into the quoting software for term and universal life, it allows you to put in their height and weight, and it will, automatically come out with, rates based off that height and weight. Tobacco. So I always just say, have they used tobacco in the last 12 months? If it's been over a year, no problem. Quote them non-tobacco. But if it is within the last 12 months or last year, it's going to be a tobacco rating for them. Blood pressure. So, is it over 140 over 90? Again, these are some things that might determine them being able to qualify. A1C. So if they're diabetic, it's always important to ask them, what was your last A1C rating? And if it was over 7, then that could certainly affect the underwriting as well. Usually that's going to only apply for the term or the universal life. And also the traditional whole life over 50,000. But again, if it's a small final expense policy, there's no medical exam, so diabetics are usually okay with qualifying for those. And then again, family history, have they had a parent that died young from a heart disease? So if the client answers yes to any of these questions, you always want to ask for dates, dosages, maybe the name of the physician. You don't necessarily have to, ask the name of the physician. The insurance carrier is always going to require that either on the application or as a follow-up. So, you don't have to really go into the weeds with that. But again, the more information that you have, the more that we'll be able to, assess that client. And this is just an overview of the attached 2-page life insurance fact finder. So again, as much of this information that you can provide, the better we can help determine, the best type of plan for your client. So name, date of birth, occupation, any dependents, like children, they married, health and lifestyle, kind of goes over all the stuff that we just talked about over the last couple of slides. And then you have this little policy matching matrix, little cheat sheet that you can utilize. So if a client's primary goal is for maximum coverage for a set time, maybe to cover the mortgage, or if they have young kids and their budget is low or a fixed budget, then the best fit might be a term life policy. If their primary goal is lifetime coverage and they want fixed premiums, their budget's moderate or a little bit higher, then whole life might be a great plan. Flexibility and cash value growth, budget is variable, indexed universal life. They're looking for permanent coverage with no frills or no cash value. They just want to have the permanent death benefit. That's very popular as well. Moderate budget, guaranteed universal life. That's the one that just has that permanent death benefit, no cash value accumulation. And if their primary goal is just a small death benefit, and again, if they're a senior, this might be the best option for them. I always say, like, if you're selling Medicare, a great way to generate some life insurance business, go back to all your Medicare clients. You can guarantee them a final expense plan. So regardless of their health, we have what's called a guaranteed issue final expense plan. No health questions. They're automatically accepted. The catch is that it just has a limited death benefit if the client were to pass away within the first 2 years. But they're very affordable. You can get 10, 15, up to 25,000, very affordable, and regardless of their health. They could currently have cancer or any of these other conditions that are, declinable. But again, just limited to seniors. It's only available for ages 50 to 80. So if they're younger than 50, then it's going to be very, very difficult to, find them any sort of coverage if they have any of those health issues. The golden question for closing, and I kind of mentioned this earlier, but if you didn't come home tomorrow, what is the one thing that absolutely must be taken care of financially for your family to stay in this house and keep their current lifestyle? Okay, that gets the client thinking and will get them to say, yeah, you know what, I am interested in getting some quotes or exploring this. Okay, and on the fact finder, it has our email address, thelifesales@pfsinsurance.com. You can send these over. We'll get back to you within 24 hours, sometimes even less than that. So if you send it to us in the morning, we'll probably get it back to you, within like an hour or two, because we know how important it is. You don't want to, your clients are waiting for that answer. They don't want to be waiting a week, 2 weeks, things like that. So we'll always make that a priority to get these back to you as soon as possible. So let's talk about some of the types of life insurance you can sell with Pinnacle. So we covered all the basics of how these plans work, but you have your term life insurance, again, temporary coverage. Most of the term is going to require full underwriting, which means a medical exam, okay? It's nothing that you, the agent, have to order. The carrier will do that, or Pinnacle will order that for you, and they'll come meet your client at a place that's convenient for them, whether it's their house or their place of business, job, whatever. It's about a 20-minute process. They collect blood and urine, and then they send those results back to the insurance company, who will then use that to determine the rate for the client. Now, keep in mind, any of these fully underwritten plans here, they do have what's called accelerated underwriting, and that's only going to be for clients that are eligible, right? And as long as, any of those previous underwriting criteria that we just went through, as long as that's like not applicable to any client, non-smoker, great height and weight, no medications, et cetera, no, driving record, things like that, the insurance company is going to say, hey, you know what? We don't need to put this person through a medical exam. We can, you know, tell based off of the information provided that they are in excellent health. So they're going to waive the medical exam. The problem with that is we cannot determine that for you. I could say, well, you know what? There's a very good chance that they won't order the medical exam. And we even have criteria that we can send out for any of these fully underwritten plans. It says, hey, here's a checklist. Again, similar to what we just went over a little bit ago, but it's ultimately up to the insurance company. It's decided by them. And if I tell you like, hey, there's a good chance, most likely they will go through, but it's just never guaranteed. So just keep that in mind. But anything that's fully underwritten just means that they're going to get the best possible rate. And I always advise, like, if a client does have a health issue, don't go with something that's simplified issue. That means that, those are pass or fail. So if the client answers a health question as a yes, they're declined. Sorry, you don't qualify. But if they have a health issue, again, diabetes or something, and they're looking for a term or universal life or even a larger whole life policy, the carriers, they might offer them that standard, table 2 rating, right? So don't think that simplified life insurance is easier. It's actually more difficult, right? So term life, whole life, universal life, we sell all of these plans. We have carriers, multiple carriers that offer these. We have the final expense, like I talked about a little bit, small whole life plans. So that means that they are lifetime coverage, guaranteed a death benefit as long as they're paying those premiums. We have the simplified issue and guaranteed issue. I just mentioned guaranteed issue would be great for clients that have health issues. They're automatically accepted. But even the simplified issue, what those are, that's day one coverage. So if they were to pass away tomorrow, they are eligible for that full death benefit. And they are very lenient as well. They'll accept a diabetic. They'll accept COPD for immediate coverage on those. Okay, and that kind of depends a little bit on the carriers too. But all the final expense, no medical exam, regardless of the client's age or their health or whatnot. It's just simplified or guaranteed issue. The simplified is just some yes/no health questions, pass or fail. Same thing like I was just saying. And then again, the simplified issue life insurance, that there are some true non-medical term, universal life, and whole life options available. Usually those clients are going to have to answer about 15 to 20 yes/no health questions. Remember, it's a pass or fail, so it's not going to be ideal for a client that has any health issues. It's going to be different from the final expense because they, if they're a diabetic, they probably aren't going to qualify for the simplified issue term, UL, or whole life, right? They have to be in very squeaky clean health. It's almost always twice as expensive as the fully underwritten plans. Keep that in mind. There's also some limitations too. You can't get more than like 300,000 of a simplified term policy. The limits. They limit everything right there. So just keep that in mind. Same thing with the universal life. There's usually like a $300,000 maximum for those. And again, I would always look at the fully underwritten ones because they're about half the cost. So just keep that in mind. And then lastly, I just talked about the guaranteed issue where it's no underwriting, no medical exam. Clients are guaranteed regardless of their health. So thank you all so much for attending. Again, this is my information and Greg Yodis's. You can always give us a call, shoot us an email at thelifesales@pfsinsurance.com. And I just wanted to back out for 1 second here. I want to show you on the Pinnacle website where you can run some of these quotes and just do like a quick example of what that looks like. So pfsinsurance.com, you log in, you go to solutions, and you can click life insurance quoting. And this is going to default to our term and universal life quoting software. If you need final expense, you just scroll up a little bit and you'll see the final expense right there. But let's just go ahead and we'll do a sample quote. Let's say I have a 46-year-old, do female, say Florida. And then under product type, you see it defaults to term, but you can do that term with simplified issue. Again, it's going to be the pass or fail. No medical exam, but it does have the $300,000 max. You also could do the guaranteed universal life, no cash value accumulation, but just a permanent death benefit. We do have the option for the indexed universal life. However, I recommend reaching out to us because this is very limited software for the IULs. It only gives you like a 10-year pay or like a pay to age 65. Does not give you the flexibility. Reach out to us, or if you're active with a certain carrier that offers IUL, you can go to that carrier's website and access their illustration software for IULs. So just keep that in mind. So for term length, I can choose, up to 30 years, let's say maybe 20 years. We'll do 100,000. And then health profile. So I can select their height and weight if I have that. Sometimes you may not have that. So just a simple way is just click enter health class, go down, choose standard non-tobacco. You can click get quotes. It's going to default to annual. You can change it to monthly. But now you can see that there's plenty of carriers that you can offer, very inexpensive because this is term. And if they're looking for, to move forward, you always want to reach out to us to make sure that you're, appointed with a carrier. Final expense is always going to require you to be pre-appointed, but if you are in a just-in-time state and you're not appointed with any of these term or universal life carriers, you can submit an EAP or drop ticket, depending on the carrier, and it will allow you to submit it without having a writing number. And what will happen after you, submit the EAP, we'll get notified here at Pinnacle. We'll send over your contract appointment. That way that there's no, you don't have to, wait necessarily for that appointment to go through. You can save these, you can download, send them to your clients. If I go back and I can choose maybe the GUL, which is the guaranteed universal life, we'll do the same thing. We want to go out to as far as possible to age 121, and I can click get quotes. And you'll see still very affordable, under $100 a month for this 46-year-old female for 100,000. Not as many carriers available for this, but you do certainly have some options. So I just wanted to quickly go over that. I'm not going to go into the weeds with all the the ins and outs of this. We can do that on a later webinar. But I hope everybody enjoyed it. Hopefully you learned something. And again, if you have any questions, feel free to reach out to us here at Pinnacle. Again, there's my contact information as well as Greg's, and then our general email box that'll come to our entire department here. So thank you so much. I'll leave this screen up and look forward to hearing from everybody. Thanks again, everyone.